welcome to Sustainability Matters, a new podcast brought to you by Anthesis. We're a global team of sustainability experts who strive to support others in achieving a more productive and resilient future. We believe that the world deserves better, and that change is vital for our people, cities, businesses, and planet. My name is Chris Peterson. I'm an Associate Director at Anthesis, and my passion really lies in leveraging the power of business to drive social value. Over this podcast series, we'll look at a whole host of sustainability issues and consider their impact for different sectors. We'll unpack the topic, explore the potential solutions, and hopefully inspire others to share in our vision. In our first episode, I'm excited to be joined by my colleague Don Reed, Executive Director with Anthesis Group. Don and I have had some great conversations around climate risk and the investor community and the expectations that are evolving within this space, and invited Don to come on to the podcast today to share some of those insights. So Don, welcome.
Thank you very much, Chris. Looking forward to the conversation.
Fantastic. So why don't we jump right in? Maybe you could start by just giving us a little bit of insight around what is meant by climate risk.
Well, the key question is really, what are the risks to business success that are posed by climate change? And those can be things like, business interruption, cost changes, brand reputation, revenue, all sorts of things. But the way we found that's most successful for how to think about that is really a matrix between the impacts of climate and then that we're used to talking about, and then thinking about operations, supply chain, and markets. So on the impacts, usually that world is divided into the physical impacts and the transition impacts. And the physical impacts in turn include things like chronic or incremental changes, things like temperature rises and changes in growing seasons and that sort of thing. But particularly for utilities, things like reduced water supply in some regions, which can affect the cooling systems for thermal power plants. But not just those kind of chronic effects, also acute or event effects like more intense rainfall events, increase in cyclones or hurricanes. And then there's some of them that are really some of those impacts, physical impacts that really cross over, like big storm surges from large, hurricane type events combined with higher sea levels, having the double whammy sort of impact. But physical side, and then transition, like how is the public policy world going to respond to climate change? And so you're used to thinking about things like a price on carbon or regulation of carbon emissions in the utility industry, but it can also be things like greater incentives for renewables and changes in market preference for low carbon power. And then you can't think about transition without also having an overlay of the technology development curves, particularly in things like renewables and storage, where that's an ordinary part of your business planning in the utility industry, but the added aspect of incentives changing that kind of break-even cost point or cost parity between renewables and existing thermal assets. All that is part of the complexity of thinking about transition risk. And then for all those kinds of risks, you also need to think about them in what do they mean for your own operations, and that's particularly true in utilities, but it helps to also think about them in supply chain and then in your end user markets. So that's kind of the framework for what do we mean by climate risk, and all of those also have an opportunity aspect to them. And we think first about the risks, and that's very real, but we definitely have some utility clients that have put a lot of emphasis on their climate analysis on the opportunities because they think they're really well positioned and they have good long-term assets for that.
Yeah, no, that's perfect. Thanks for that overview, because I think that is that interesting insight, right? Is that there's this evolving and emerging focus and structure around how people are thinking about this climate risk space, and it feels like it's evolved from being a relatively vague concept to one that is a lot more robust, as you're saying, that having these really kind of clear elements to it. And I guess maybe building off of that, kind of why do you think that that's coming up more and more now? right? And are there key drivers within that, or things that are really impacting that currently?
Yeah, I think there are probably three things that really drive it, in particular in the utility industry. And the first is just sort of the general ambient awareness about climate change as a big societal issue. And it's closer to the front of mind for a lot of folks. And so that's true in the utility industry, your customers, your investors. And so that's a big, sort of general one that sort of elevates the issue. I think particular to the utility industry, investors, particularly global investors, have an example or two that make them think that this could be a big issue in the utility industry. And we know that these examples aren't necessarily, I think that the probably leading example is the German utility industry. And we all, as all of us focused on the utility industry, understand that, well, the German utility industry is quite different and unique in different set of circumstances. But if you're an investor that invests across a lot of different industries, you might just see the example of Germany and what happened with the utilities there as being, well, why couldn't that happen here? And are companies really ready for it? Because Germany really adopted the Energiewende policy, which provided a lot of incentives for renewables behind the meter. And that really drove down wholesale power cost, enhanced the profit margins for conventional generation, and had a huge impact on the valuation of utilities and drove merger activity in the space, et cetera. And so that really sort of set the stage in the industry for thinking about this as a new and different source of uncertainty. And investors are used to uncertainty in general, but they think about it, utilities, as being a relatively safe, sort of sector. And so any sort of new uncertainty or different uncertainty with different qualities kind of feels prominent. And I think the third reason why this is really on the agenda is the Task Force for Climate-Related Financial Disclosure, which is a G20 finance initiative to promote reporting on these risks in regulatory financial filings. And it's a framework for a disclosure, which ends up really setting up a framework for analysis. And so it's very useful that way. It has key features of, requiring or, suggesting really scenario analysis and, saying like, well, how would you be ready? And what would be the financial implications if there were no effective action on climate change and there were lots of physical changes? What if it was just business as usual? And what if the action for there were effective actions for limiting climate change to 1.5 or 2 degrees Celsius? And all of that is, it's a new reporting framework, and so it attracts some attention, and some investors will have already begun engaging companies in the utility industry about, are they reporting? When will they be reporting against the standard? But I think that don't do it just because there's a new standard. You do it because it's a good business choice. But those are three of the factors really driving this onto the agenda.
Yeah, no, that's really helpful. And maybe just circling back to the investor climate, because I know that's an area that is always fascinating digging in with you. Do you see that evolving relatively quickly? I know that there's been this kind of shift in mentality that we're hearing about in practice. The BlackRock comments and drivers and reports, et cetera, as an example of that. But is that something that you're seeing reflecting in practice? Is that something that you think is kind of mature at this stage, or is evolving and growing over time, or how do you view it as someone in this space?
Yeah, so I think the trends, you're absolutely right that the trends are still in that early stage, that there are definitely some thought leaders on the investor side that are vocal advocates for doing this kind of analysis and providing disclosure. BlackRock is a good example, but there are others, institutional investors, that are, have publicly announced that they will do this disclosure themselves and that they will advocate for the companies they hold to also do it. I think that it's still early days, because I think that the institutional apparatus that really gets that rolling is just starting. But you're seeing very public examples of investors saying this is how they're approaching the analysis. This is how they're thinking about these risks, and then engaging companies around their analysis and disclosure on it. And so, yeah, it's definitely building and has the potential to move very quickly. I guess I wouldn't, I stop short of predicting that because, I think a lot of times there's the talk about these kind of changes precedes the action. So there'll be a lot of talking before there's lots of action. But I would say that utilities, along with the oil and gas industry, some parts of the materials and chemical industry, will be are already the first sort of key targets for those investors.
Yeah, no, and I think it was interesting kind of indicator for me to just kind of reinforce your statements there of seeing that BlackRock, as an example, is really investing in that regional data sets to understand what do those climate risks look like for their investments, and trying to map that against the location of the utility assets, for example, right? Which speaks to that next step from lip service to really starting to recognize and differentiate their investments within that.
Right, and we've, parallel to that, we've also done work with the utility groups at a commercial bank that was really looking to upgrade significantly their analysis of these issues across their whole credit portfolio. And we really did that by drawing on numerous public data sources, some of them very specific to the asset location, but also very specific to their regulatory situation. Because just because you have have large emitting assets doesn't mean you're going to get that there are going to be challenges around cost recovery. It's a more complicated situation than that. And so, yeah, the level of sophistication of that analysis is growing pretty rapidly, and adoption of those kinds of techniques on the investor and lender side is the game's afoot.
Right. Yeah. Well, so assuming you have now scared people, how do you recommend that organizations respond to this based off your experience and what you're seeing out there in the marketplace?
Yeah. Well, so I think that you never really want to come at any of this from a point of fear. I think what you want to do is really come at it from the point of, this is a business issue and we want to treat it as such. And so we really recommend a 3-step process where you really assess what risks you have on these and where your opportunities are. So an assessment phase, and then really evaluate the business impacts quantitatively. And that gets to the application of scenario analysis. And then you really want to optimize your response plan. And where most utilities are really in that assess phase. And so where you really want to look at, where do we have value at stake on climate change broadly? And that language is chosen carefully because it really is both risks and opportunities. Where's their value here? What's the order of magnitude of that value? Which of these impacts is most important to us and our utility and our strategy long term? And then what are the value pathways that you expect to see that follow? So is it around a price on carbon that changes the generation mix? Is it incentives for renewables that decrease demand because there's greater cost parity behind the meter? All those kinds of questions. So you really try to narrow the universe of topics to focus on. Where are there physical risks to our actual plants, with water availability or persistent flooding? How are they hardened? How are they insured? But really narrow it down to the set of risks and opportunities that you think are most important, salient for your company, and then move into that evaluation of business impacts, using quantitative techniques, and be testing your response plan, and maybe refining, but certainly testing your existing plan for how you deal with climate change risks and opportunities, but then be open to what are there other response plans that are better suited to your particular situation and are more valuable under a full range of different scenarios.
Yeah, no, that's great. And it's fascinating to see how that develops. And I'd be curious to hear, I know that you've supported a number of companies in understanding this, understanding the growing investor pressure, how best to respond to that. Have there been any kind of key lessons learned through that in terms of how companies have approached it, and in particular, how they've extracted value from that effort, whether that's communication to an investor community or changing of practices internally?
Yeah, so I think that there's a couple of things, and some of these, this is very straightforward, so not exotic. First off is really to get started and don't be paralyzed. I think that a number of companies have looked at the TCFD's sort of framework and what they're asking for and thought, oh my God, this is grandiose. How are we going to do this? This would be really hard, maybe outside of our organizational capability. And we just think that that's the wrong response. You don't want to be paralyzed by these great ambitions, but really say, oh, okay, every journey starts with a step. And so we're going to begin with some assessment. We're going to build a multifunctional team on our side that can be understanding what's going on in the market and laying out plans for how you would do this kind of an assessment as a first step. Also, it's really important to come at this from a mindset of this is good business planning, and you want to take it all in and think about this in conjunction with other things going on in your business, not as an isolated thing, and multifunctional teams really help with that. Some of the other things that have been more, I think, specific to utilities, I think particularly like the risks and opportunities thing, like I mentioned earlier, but it really is true that a lot of power generators and utilities have great opportunities in this space, and they may or may not be well positioned for that, but to really think about it, really as both opportunities and risks. One of the challenges is that a lot of business planning has a relatively short time horizon, and sometimes even in the utility industry where assets are extremely long-lived, that the planning horizon is constrained, and a bunch of these impacts they're already occurring, but they're anticipated to be happening over long periods of time as well. And so having longer time horizons, or willing to experiment with longer time horizons, is very much to your advantage to be able to say, oh, okay, maybe this is not, or these issues are more important in the near term, but there are some other things that are really important in the long term, and we want to build understanding and capability over some of those long-term issues and not just concentrate on those that are we know are already important in the near term.
Mm-hmm. Well, and I think, as you said too, like with the long-lived assets within the utility space, right? That some of these short-term decisions have very long tails to them. And I guess just out of interest, when you think about the investor community, are there specific groups within that are thinking that longer term, that are shifting to expectations around this, or is it still that kind of short-term impact and considering what are the implications of this back-end risk to the ability to kind of transfer those assets?
Right. So it's really important to be able to understand the full universe of your investors, and that we hear a lot from the active investors that are moving in and out of utilities and your particular company, and that there's an analyst community that follows them, and they attend your quarterly earnings calls and things like that. And that's a very important part of the shareholder base. But there's also a whole other part of your shareholder base, which are large, passive, long-term investors, really permanent holders. And that's, represented by, investment firms like BlackRock, but a number of others that own your company because you're part of an index and they're tracking that index, and they don't buy and sell around your latest trends and news, and they are really permanent holders of you. They tend to engage your company at the board and corporate secretary level rather than at investor relations. And they have the mindset that they're going to own you forever, so they want you to get this right. And so they may be a very important constituency for you for this, but they have different access points to your company than perhaps you're used to working with.
Right. Yeah, no, that's great. I think that's really helpful insight. And maybe just, I don't know if you have any perspective on the bond market as well for those that aren't necessarily investor-owned utilities, but still looking for those ratings.
Yeah. So I think that the debt, or similar to the lending world, is a little less exposed to the risks and opportunities than the equity world. And so they are maybe one step behind in timing and rigor on analysis of these issues. But we increasingly see fixed income investors paying a lot of attention to these topics and really adopting the analytical techniques of evaluating these issues from their fellow investment professionals on the equity side. And so I think that that is, they have a big difference, of course, in the sense that they're thinking about this in terms of the impact on credit quality. And so cash flow coverage is their, kind of lingua franca. But there are definitely many of them that are increasingly thinking about this as a part of the mix. But I think they are maybe half a beat behind the equity investment professionals on how to integrate this into their investment decision making.
Great. No, I think that's really helpful insight. And then maybe just a couple kind of final questions before we look to wrap up.
Sure.
You had mentioned kind of this overall process, and I'm curious time-wise, right? Given that we are talking about these like fairly significant kind of efforts to really get our heads around where this is going and kind of that pivot within the organization. What kind of time frame should an organization be thinking about when they're thinking about implementing a plan or really getting started on this journey?
Yeah. So I think that the time to be thinking about and building support for the idea of doing this kind of analysis, if it doesn't already exist, is now, because we really find that getting started early is a long-term advantage, because it enables you to socialize the idea across those kind of multifunctional teams that you're going to need to have to do this. And it doesn't have to be a multi-year process to begin with. It can really start with, okay, we're going to create a multifunctional team. We're going to organize our horsepower to do that assess sort of phase and think about that. We're going to school up a core of people that really understand that. And all that can happen in the course of really just a couple of months. And so I think it gives, but I think the key is to start thinking about real action steps now to get that process in motion, because all of our organizations are kind of slow to get moving. And you can use examples of other utilities and power generators that are reporting on this, and being able to see out there in the public domain what some of them are sharing with regulators as well, and sort of get a sense of what the speed of traffic is out there. Not that you should do what everybody else is doing, but rather that you should understand what's happening in the market, that your investors are seeing others do, and that all that is helpful in kind of getting something started on this.
Great. And then the last question I have is around kind of extracting value from the effort, right? And I see lots of channels for that, but just curious if there's a few key takeaways that you've had through your experience of, when you initiate on this, here's how you set yourself up to really get the biggest return.
Right. So there's some real simple early returns that you get from doing this kind of work. And some of it is, just directly from those investors where you're communicating, hey, we're on this case. We are flexible in our thinking about this, and we've got a process in motion. And with a number of investors, that's just a big plus, because their greatest fear is that companies they hold don't have this on their agenda and aren't thinking this way. So I think that's a quick, kind of early return. I think that same sort of return can happen with regulators as well, and with policymakers. And that's, of course, really specific to your own jurisdiction, your own rate regulators, if you have them, and all. But I think that's again a real early return. What we found in some utility clients, when we've actually gone from the assessment phase, which kind of gives you that roadmap of where you should be concentrating, and into the evaluation phase, we found that a couple of them have really seen a new kind of way of seeing the value of their investments in renewables, efficiency, and storage, and seen in scenarios where those assets are even more valuable and have a stronger business case than they would have had otherwise, than they had currently. And it's that, the rigor of the process and really looking at that across different scenarios is really valuable in being able to say whether, how valuable are these assets, and how do we think about what that value looks like over time. And we do have a client who's done that, and who was almost was hesitant, I should say, to talk publicly about the value of those assets over a long period of time, just because it was so much more valuable than they had thought when they started making those investments. And it was almost like admitting, oh, we didn't even really know how good this was.
Right. That's the outcome you want from that versus the opposite, right? But I think what's interesting throughout all of this has been your kind of that consistent message of it's better to know, and that expectation with investors, right? Of we expect that you will know these answers, right? And we're going to start asking those questions. So, Don, this was fantastic. Thank you very much. Anything you missed, or any final comments from your side?
Wonderful conversation, and really look forward to more of these kinds of conversations at the utility company level.
Fantastic. Thanks, Don. And then just for anybody who's listening and who'd be interested in reaching out, your email address, again, is donreed@anthesisgroup.com. That's DON.REED at anthesisgroup.com. And just want to say, thanks again. Really appreciate the insights. Thank you again to everybody for listening today, and looking forward to connecting with you again soon. I can be reached at chris.peterson@anthesisgroup.com, and look forward to connecting with everybody at the next chance we have. Take care.